Okay. All right. Good evening, everybody. I hope you're all doing well. We'll probably have a couple of people still jump on here, but I don't want to hold you guys up, those of you that were here. So we're going to dive right into this thing. Welcome to everything you need to know about buying a home in 2023. Congratulations on taking the first step towards home ownership. My name is Nick Barta. I am with Security First Financial. I've been a little bit about me. I've been in the industry for about 33 years, give or take a few months. My team and I have assisted thousands of homeowners in buying their first home, second home, third home. I've been ranked as the #1 FHA loan originator in the country, either one or first or second in the last 5 years. I've been among the top 15 loan originators in the country in overall transactions closed, recognized as the #1 down payment assistance originator in the state of Colorado, and most importantly, a proud husband, dad, and grandpa. Grandkids call me Papa Nick. So that is kind of who I am. We're going to go kind of on a journey, through the mortgage process and the home buying process. And usually where we want to start is kind of the common myths about buying a home. There's a lot of misinformation out there, guys. So, first of all, we're going to go into a lot more detail on these, but just real quick, I need 20% down, to buy a house. I need perfect credit. The process involves too many hoops to jump through. It's just a hassle. It outweighs the benefit. Renting is more cost effective than owning. I'll be trapped if I stay in the home for a specific, I have to stay in the home for a specific number of years after buying, and interest rates are just too high right now. So most of these, as a mortgage guy and a guy that has helped so many people buy houses, and achieve that American dream over the years, these make me cringe because they're simply not true. And so I think if we go through these kind of one by one, you're going to find out that what you hear on the street is just not reality. So I need 20% to buy a home. This is just absolutely not true. You don't need to have 20% or anywhere near that. There's several programs out there that you can buy with as little as 3% down. There's conventional loans with 3% down. There's FHA loans with 3.5% down. If you're a veteran, if you're a qualified veteran, first of all, thank you for your service to our country. You can buy a house with 0% down payment. If you're in a rural area and you want to buy a place, you can buy a house with 0% down. And then there's so many down payment assistance programs that are just really, Colorado is so fortunate to have them. We see people get into homes for as little as $1,000 down. So, that 20% down, that's kind of what, mom and dad, maybe grandma and grandpa will tell you. You need this big chunk of cash. You just, it's hard to save money in this, in this economy. It's very hard to save money, working a regular job and just paying your bills. So coming up with 20% down, unless you got a rich uncle, it's pretty tough. So that, you don't need 20% down. I need to have perfect credit. Absolutely, you do not need to have perfect credit, and most of us don't have perfect credit. If you do, good for you. That's great. It makes it easier. If you have perfect credit, it does make it a little bit easier. But we have FHA financing. You can go down to credit scores as low as 500, or with 500 with 10% down, or as low as 580 with just 3.5% down. You can get down payment assistance with 620 FICO. So, those really low out-of-pocket situations you can do with as low as a 620. The one thing about down payment assistance is that it doesn't matter whether you have a 720 or a 620, you get the same terms, you get the same interest rates. If you're not doing down payment assistance and you're doing a regular FHA, VA, conventional, or USDA loan, yes, the better your credit score is, the better that interest rate can be. But don't let that be a barrier, or don't let that stop you from diving in. So if you're, you can get a qualified mortgage professional can help you improve your scores, give you some advice. We do that with a lot of clients that come in and they're not quite there, but they just need a few pointers, and we can give you those pointers and help you get to that next level. You know, and if your credit's really challenged or there's a lot of stuff that's not accurate on there, then you might want to look at a reputable credit repair companies, which we have a few that we can refer out to you. We're not affiliated with any, but we certainly know who does a good job out there. So again, you don't need perfect credit. Too many hoops to jump through. So again, this is a myth. The home buying process has changed a lot, guys, over the last 20 years. It's just different. You know, keep in mind that you have a mortgage company or a bank that is borrowing you, you know, hundreds of thousands of dollars. So it is a little more. They're going to ask you a little more than they would ask you if you're buying a car, you know, or a piece of furniture or a TV, you know. So there's a few more hoops to jump through, but are there too many? No. And I think if you know what you're getting into when you start from, you know, when you're starting from scratch and you know kind of what to expect, it certainly makes it a lot easier. I think that the customers that we work with that are probably you know, that probably get more frustrated are the ones that don't really know what they're getting into, and we try to educate them. And so this is a great step. So again, thank you guys for being here, because this is, you know, it gives you such an advantage over the average, you know, buyer out there. So I think it's important to partner with an experienced lender. There's so many different programs and there's so many different options that you need somebody that is not only familiar with all the loan programs, but willing to kind of take a look at your situation and figure out, you know, what's the best situation for you. Is that down payment assistance? Do you have a down payment? Are you a veteran? You know, what gives you the best payment? What gives you the least amount out of pocket? You know, those are the things you want to look at, and you want to look for an experienced lender. Obviously, I recommend me. So, but in my team. But I also think that working with a local lender gives you a very distinct advantage. You know, the online lenders are great if you want to work with a call center person that's going to talk to you for 15 minutes and pass you off to somebody else. So with us, we're very well known in the market. And so I think that that's a definite advantage for us. Okay, it's not worth the hassle. It's cheaper to rent than own. So this is kind of a complicated thing. Sometimes rent can be cheaper than your mortgage payment. Not always. Sometimes it can be, but when you take into consideration rent is, you know, it's 100% interest rate. Every dime of rent doesn't go towards any benefit of you other than giving you a place to live. So if you guys are you know, paying a rent payment of $2,000 and you are paying a mortgage payment of $2,400, that extra $400 goes to pay down your loan, the amount that you bought. Plus, it puts you in a position to gain equity. In the state of Colorado, gaining equity, we've gained, even in bad years, we've gained 4% equity. So, you know, that let's say you buy a $300,000 house, you're going to pay $400 more, let's say, in your mortgage payment than you are in rent. That's $4,800 for the year. That $4,800 goes directly to pay down your mortgage, plus appreciation of $300,000 at 4% is another $12,000. So the trade-off is you basically get $12,000 more in equity. And that's on a very conservative side, because 4% appreciation in Colorado is very normal, but we've been as high as 15 and 16, 17%. During the pandemic, it got up into the 22% range. So, you know, we know people that bought houses 3 years ago and have $100,000 in equity now. So, you know, certainly the benefit is there. And don't let anybody tell you that you can't buy, that it's too hard. If you want to buy, you know, sometimes it takes a little bit of elbow grease, a little bit of legwork, but you know, we're there to really work with you. I think that one of the other, that's not on here, one of the other common misconceptions is that as a lender, we're kind of the gatekeeper on the money. Trust us, we want everybody to buy a house. We want everybody to get approved and everybody to get a loan, because quite honestly, that's how we get paid. We're not like banks, you know, we're a mortgage company. So, you know, if loans don't close and transactions don't close and we don't help people, you know, there is no income for us. So it's completely our job to try and get you guys the best program you possibly can. So let's go to some additional advantages of home ownership. So some of the things people don't think of. First of all, building wealth. The single best way to build wealth in the United States is real estate. Most people who, let's just say you make $6,000 a month, you're paying your bills, you're raising your families, you're doing your thing. Over a 3 or 4 year period, it'd be very difficult to save a good chunk of money. Yet when you own real estate, it's almost like having this part-time job. You own real estate and that house works for you. That appreciation happens for you. So you take the, you take the appreciation, and some people will build, we've seen people build $100,000 in net worth over a very short period of time, sometimes 2 years, 3 years, 4 years. And I don't know about you, but certainly when I was younger and I had a family and I was trying to, put food on the table and pay my bills, there was no way that I was going to save $100,000 in 3 or 4 years. So again, building wealth is really, it's really crucial if you can own real estate. If you ever want to be somebody who owns a lot of real estate, the first step is always own your own home, because you create that equity. You can use that equity to buy other properties. Some other things, just with different studies that have done, owning home significantly reduces the occurrence of crime or violent assault in a household. Children raised in owned homes are healthier and perform better in school. Homeowners and their families experience improved mental health and fewer developmental problems. Children from home ownership families outperform children from renting in both math and reading. These are all studies that were performed. They're certainly not Nick Barta stuff or Security First Financial. These are just independent studies. So just something to keep in mind. Not only do you get this, build-in wealth, not to mention if you want to knock down a wall or you want to paint one purple, you can do that without having to worry about it. So the other one, I have to stay in my house for years after I buy. Listen, there's no rule that says you have to stay in a house for any amount of time after you buy. Now, we do suggest you want to be in the house for a year or 2 years or 3 years to be able to build that equity and have that equity to take with you to hopefully purchase another home. But there is no specific time requirement. It's not like there's no latching you to the front door and you can't leave. So it just is, depending on the market and the upward trends, you want to be in there long enough to be able to make sure that you can actually get the money out that you put in. So interest rates are too high. So believe it or not, sometimes higher interest rates are your friend. So yes, it pushes your interest or your payment up there a little bit sometimes, but you also have far less competition out there in the open market. So during the pandemic, interest rates were very, very low. But when you went out, somebody put a house on the market, most of the time there were 30, 40, 50 offers on that house. And if they listed it for 400, they would have offers up to 450, 470. And so you'd end up paying $70,000 more than the house was really worth, or at least listed at. And it was just this crazy, this crazy time. And so in, say, today's world where the interest rates are a tad bit higher, a lot less competition. Very few people are paying over the ask price right now. In some situations, you get into some competitive situations where it's a little bit over, but also you're able to get seller concessions. They'll help you with closing costs and things like that. So we always say, date the rate and marry the house. So what you want to do is get into the house. You want to own the house, because when rates do come down and they get down to, and this market takes off again, then you're back to competing. But if you already own your house, all you got to do, all you have to do is then you refinance to a lower rate, you get that better payment, and you get the advantage of having purchased your house at that lower amount. So, so don't be afraid of the rates. Obviously everybody's got to be comfortable with the payment, but sometimes you have to make a little higher payment for 12 months. We certainly see interest rates coming down over the next 12 to 18 months. I've been doing it a very long time. This has been a volatile time in the interest rate market, but it's also been a really good time to buy a house. So don't shy away from it, because there's interest rates are a little bit higher. So now, I'm 11 slides in, so I'm assuming you have decided that you want to buy a home, and you guys showed up, so I'm assuming that's you want your dream home and you want to know why. So where do we start? So first of all, obviously consult a lender to understand your current financial situation. Again, I know a pretty good one. I can help you. If you guys are ready to go, you can always go to that link, apply-nickbarta.com. There's in the handouts, guys, feel free to download the helpful links and resources for first-time home buyers. There's a lot of links on there. So some of the things we're going to continue to talk about, there's always that apply. You know, you can schedule a time to talk to me or one of my mortgage consultants. I don't hire call center people. I hire very experienced people. Most of the people that have been with me for several years and really learn from, you know, the ground up. So we're going to go over, you know, next kind of the four things lenders look at, kind of pull the curtain back on that. We look at, you know, the 4 C's are credit, capacity, collateral, and capital. So let's start with credit. So biggest barrier, you know, you guys might know this, the biggest barrier to home ownership, the two biggest are credit and down payment. You know, like we said, you don't have to have perfect credit, but you got to get in the ballpark. So, you know, is your credit score at the level that you want it to be at? Is it at the level it needs to be at so you guys can qualify for your the house that you want to qualify for? So, you know, we can take a look at that. You know, if we go through an application with you, we're going to pull a full credit report. Either me or one of our mortgage consultants is going to go through that credit report with you. And if your score is where you're at, you know, then you're great. We move on to the next thing. If it's not, then we'll look at it line by line with you to try and figure out how you can get your credit score boosted. You know, the number one, other than late payments, which we really can't do a whole lot about, but the number one score killer is usually revolving accounts that have a credit limit or a balance that's over its credit limit or close to its credit limit. So a lot of times you'll have a Kohl's card or a Home Depot card or a Capital One card, and it's a Visa or a MasterCard, whatever it happens to be, you know, and you have a $500 limit and you owe $495. Well, that's worth as much as 40 points sometimes on credit. So you want to make sure any of those revolving accounts, there's different levels that you want to hit. You know, the first one is you want to never be over 50% of your credit limit. So if you have a $2,000 credit limit, you don't want to owe more than $1,000. Now, if you can get that to 35%, you get a few more points. Between 35 and 0, you know, there's really not a big change. So then you get to 0, you get more points at 0. And so those are things you want to really keep track of your revolving debt. New collections, if you have collections that have popped up and they're new, whether they're medical or not medical, those can really bring down your score. We normally wouldn't tell you to pay medical collections off because as mortgage lenders, we don't really care about medical collections. We do have to look at other collections. So if if you have a collection for Verizon or, you know, something else you didn't pay or, you know, and it's not medical, those are things we do have to address. If they're above $1,000 or collectively above $1,000, we have to come up with a plan to either have them paid or kind of payment against you. If they're medical, however, we ignore them, but medical ones can hurt your score. So when you're looking at that and it's a new medical collection, it might be worth paying the $50 medical collection to try and bring that, you know, get that off your account, or at least show it paid. So we can go through those things and go through that account with you, go through your credit report and really give you the tips and the things that we see. You know, we see hundreds of credit reports a week, so we can certainly go through those with you guys and give you the pointers you're going to need to get you to where you want to be. Potential barriers, I do want to mention that, I mean, there are some things we just can't get around. So you guys need to know that going in. Bankruptcy is a big one. We see a lot of bankruptcies, and if you've had a chapter 7 or chapter 11 that has been, chapter 11 is usually business, but sometimes they pull in personal, and it's been discharged less than 2 years, you do have to make that 2-year mark to be able to do a new mortgage loan. If it happens to be a chapter 13, however, there's an exception to that rule. That's 12 months. So chapter 13 is one where you make payments back. So it's just not automatically forgiven. All your debt is, you actually have a payment structure the court sets up with you. and then they will, you start making those payments. Once you've made 12 payments, then you can be eligible. I mean, there's some other factors involved there, but you can be eligible to get a mortgage loan. Foreclosure or deed in lieu of. So that means that if somebody took that, if you had a house and somebody took it from you, or you lost it to the bank, or you deeded it back over instead of them going through the foreclosure process, there's a 3-year waiting period on that. So once that happens, we do have to wait 3 years from the time it's finished. So expert guidance, I think that you want to seek an experienced lender to guide you through the process. And so I put on there, did I mention I've been doing it 33 years? So kind of self-promotion there a little bit, but you understand that credit's complicated and we're here to help. Capacity. This is really your ability to pay money back. So this is your ability. This is what the banks will judge you on, or the underwriters will judge you on, to see whether you have the capacity to pay the mortgage that you guys want to get. And so, you're going to hear debt to income, or DTI, a lot. Debt to income ratio you hear a lot. So there's 2 kinds of debt to income ratios. There is a front end and a back end debt to income ratio. So the front end, and I'll show you how to calculate those a little bit, and probably dive into that on the next screen or the next slide. But there's DTI limits. So basically, debt to income limits are, the front end is going to be your mortgage payment divided by your gross monthly income. And when we say gross monthly income, we mean your income before they take anything out, before they take federal or state taxes out. If you pay health insurance out of your check, it's before that. So, if you make $20 an hour times 440 hours and you make $800, that's your gross. Your gross for that week is $800. So we're going to take that times 52 divided by 12, and that's the figure that we would use. So you're not taking the amount that goes into your bank, not that net amount of the check. We're taking the gross. And so they take your monthly payment divided by that gross amount of gross monthly income. That's your front end ratio. Your monthly payment plus all of your payments, your card payments, student loans, credit card payments, any other installment loans, and you add that to the mortgage payment, and then you divide that by your gross monthly income, and that gives you your debt to income ratio. So I'll kind of show you an example of that next. So let's say your monthly pre-tax income gross income is $6,000, or your estimated mortgage payment is $2,500. That would be 2,500 divided by 6,000 is going to give you 0.417, or a 41.7% debt to income ratio. That's how that front end is figured. With the back end ratio, which is what we also look at, the back end ratio is probably looked at more because that's the one that people get more restricted on, because let's face it, a lot of us have some debt. So let's say you have a $500 car loan, a $55 student loan payment, and then a minimum credit card payment of $30. So we'd add all that up, 2,500, 500, 55, and 30, come up to 3,085. We would divide that by the $6,000 gross income that you have, and you'd come to 0.514, or 51.4% debt to income ratio. So a lot of kind of where the program you guys fit into is going to matter on that debt to income ratio. So some of the things that are going to determine which program works best for you is your credit score, and your debt to income ratio. So FHA loans allow for the most lenient credit scores and the highest debt to income ratio. So if we do a lot of FHA loans. Like I said in the beginning, I do more than anybody in the world, and so we're very well we know FHA very well, forwards and backwards. Our underwriters are in the office here with us, so we can ask them if there's anything a little bit outside the box. So conventional loans, if you have better credit and you're not pushing your debt to income ratio too high, they're going to be a great fit for you. The advantage to conventional is they're received a little better in the field. Sellers like to accept, the conventional loan applicants, buyers a little bit better in FHA, but they're coming around. So in a tight market, it's nice to have a conventional option. In the market we're in currently, we're getting a lot of FHA loans accepted right alongside of conventional. So definitely wouldn't shy away from either one of them. But let's go to capital. So capital is down payment. It's just a fancy way to say down payment. So capital is what you're bringing to the table. It's what can you bring from a down payment assistance program, to the table. And guys, I failed to mention, if you guys have questions, you can put them in the chat down below. I'm probably going to wait till the end to answer some of those questions, just because we've got a lot to go through, and hopefully we'll answer some of those as we go through there. But if you have just a specific question, throw it in there. If we don't get to it before we're done tonight, we'll definitely reach out and we can answer it by, either over the phone or via email. So, but capital is down payment. As we discussed, you don't need 20% down. And you may be asking yourself, where can I get this down payment? Where does it come from? So there's a lot of sources. And I think that one of the things a lot of lenders won't tell you is how to find, what we can use for down payment until it's too late. And we're like, oh, hey, we can't use that. Obviously the easy ones are savings and checking and investment accounts, stocks and bonds. If you own those, you can use those for down payment. You can use gifts from relatives. So like if your mom and dad can give you some money, or grandma leaves you some money, or you've got an uncle that wants to give you a little bit of money to help you out. I've even seen ex-wives give husbands money to, I think it's so they get out of the house, but they've gifted them money. So, and you can also, I've even seen employers will have gifting programs where if an employer, they want to help their employees buy houses. One of the other benefits I didn't mention for employers is employees are much more stable if they are in an owned home than if they're in a rented home. So that's why the employers a lot of times will incentivize people to buy homes. Withdrawals or loans against your 401k. So I get this a lot where people have a 401k and they don't want to take money out of it or borrow money against it. Some 401k plans will allow you to actually withdraw if you're buying a house. You can check with whoever has your 401k and there's no penalty for it. Sometimes they'll allow you to borrow against it. I do get that question. They're like, well, wait a second. If let's say I take $20,000 out and I'm making 4% interest on that, I'm giving up that 4% interest. Well, that 4% interest is $800 in a year. And so if you take that $20,000 and you're able to buy a $300,000 house with it, and you make 4% on that $300,000, which is what the appreciation normally is, again, it's another $12,000. So I don't know about you guys, but I would trade my $800 gain in my 401k for the $12,000 gain in equity any day. So don't be afraid to use that 401k. You're going to make it back in equity. You can also sell something, like you can sell a vehicle, you can sell a motorcycle, you can sell a boat. You just want to keep the documentation you have when you do that. We need a paper trail to show where that money comes from. There's down payment assistance. We're going to go into that in a little more detail. Down payment assistance in Colorado is, we are so blessed. We have really, out of all the states that we work in, Colorado is far and away the best down payment assistance program state. So a lot of times people won't tell you that you can get a secured loan as well. So if you have a car that's paid for, you don't want to sell it, you could go get a loan on that car. I mean, that payment does go into your DTI, but if you don't have a lot of debt and you have your car paid off and you want to go in and you need down payment assistance, you need $5,000 or $6,000, you can easily go get that on a car. As long as it's borrowed unsecured, we can use that for the down payment. Now, I'm going to go, this will be a little bit of gray area. So I'm going to tell you, lenders only look back 60 days. So whatever you do 61 days and further back, we don't really dig into that. So, if you're going to be buying in September or October, and you don't have any savings, you need $5,000, $6,000, $7,000, $8,000, and you have a credit card that has room, you can easily take a cash advance on that credit card. You can go get an unsecured note at that point and put it in a savings account. And as long as you put that in 61 days prior to when you need the loan, we're not going to go back and verify where that is. So I'm not saying that works for everybody, but I am saying that it is there. One other thing I need to mention, if you guys were like a lot of people and you hoarded some cash at home during the pandemic, and you've got $5,000 or $10,000 in a safe at home in the closet, and you want to put that in the bank, please talk to us about that. Let us know that's what you're going to do, and we'll come up with a plan to put it in there. There's a couple of reasons. A, it's hard to source cash, so we want to do that strategically. On an FHA loan, any deposits less than 1% of your purchase price, we don't have to source. So if you're buying a $400,000 house, we don't want you to put $4,200 in there, because then we have to source all that. If you put $2,000 in this week and $2,200 in next week, we wouldn't have to source it. The other reason that you want to do that is if you guys walk in with $10,000 in cash to your bank and you deposit it in one fell swoop, they are required by law to report that, and the IRS will probably come knocking on your door, or somebody will, to make sure that you're not laundering money or selling drugs or something like that. So that's really what those are in place for, is to make sure that they have control over that. So we don't want you to go out of your way to dive in to buy this house and then end up putting yourself in harm's way. So if you've got a big chunk of cash and you need to get it in the bank, certainly talk to, if we're your lender, hopefully we are, talk to us about how to do that. So collateral is the property that you buy. It's just what they're going to take an interest in. So we do deeds of trust in Colorado, and what that does is that gives the bank or the mortgage company an interest in your property. If you don't make your payments, they can come and take the property. If you do make your payments, they leave you alone. They're happy to get their monthly payment. So you do have to, the properties do need to be a suitable condition to qualify. They can't have safety hazards. Most government loans require safety hazards be repaired. Condo projects, if you run into a condo project and you're FHA approved, those need to be, the condo projects are actually FHA approved or not FHA approved. So you're limited a little bit when you're looking at condos with FHA. HOAs, by the way, the Homeowners Association dues that come with condos and townhouses and even some single family, those do get figured into that debt to income ratio. So that is something you have to consider when you do that. Townhouses do not have to be FHA approved. The projects don't have to be FHA approved. It's just kind of a quirky thing with condos. And so there are, if you're looking to buy a house that needs a lot of fix up, there are other programs that are, there's an FHA 203K program. There's a Fannie Mae renovation program. Those are kind of built to buy a house and do the repairs. That is a whole nother webinar though, guys. Those are, if you have interest in that, shoot me an email or pop a note in the chat, and we can reach out to you kind of with those details. Let's talk about down payment assistance. I've been bragging about down payment assistance in Colorado, and CHFA, Colorado Housing and Finance Authority, is just one of the best in the country. Minimum FICO scores of 620. Income limit actually just went up 2 days ago. I didn't get this changed. It's $160,300. So if you or whoever's going to be on the loan makes $160,300 or less, you can be eligible for this down payment assistance. That down payment assistance comes as either a grant or a silent second. There are some advantages to using the silent second. You do have to pay it back. However, the interest rate is significantly lower and you get 4% of the loan amount. With the grant, the interest rate is quite a bit higher and you get 3% of the loan amount. So your cash out of pocket is quite a bit higher with the grant. But depending on your situation, either one of those can work out great. It allows you to get into a property. The only requirement CHFA has is that you have $1,000 into the property. So normally you need about $4,000 plus 1% of the purchase price. So if you're buying a $300,000 property, you're going to probably need $4,000 plus 1% or $3,000. So you need $7,000 total. And in some cases in this market, certainly we can get, and sometimes the real estate agents can get the seller to pay some of those closing costs, so you can reduce it down. That's how we get to $1,000. Sometimes you have a property that's sat on the market for a little bit, and you've got $7,000 to bring in. You might get $6,000 from the seller in a concession, and you only have to bring in $1,000. If you have earnest money in that case, let's say you have earnest money of $4,000 and you get the $6,000 from the seller, at closing you would actually get you would get your earnest money back, except for the $1,000 that has to stay in there. One thing that's a misconception too, for down payment assistance, you don't have to be a first-time home buyer. First-time home buyer, guys, it's defined as somebody who has owned a home, not owned a home in the last 3 years. So if you owned a home 4 years ago, you're still considered a first-time home buyer. However, if you owned a home currently and you're selling it, or you're keeping it, or you owned a home a year ago, there are programs with CHFA and actually Metro DPA, which we'll cover here in a little bit, that allow you to still own a home or to have owned a home and not be a first-time home buyer. So don't, a lot of lenders will push you away from this, and I will be very candid and tell you the reason that they will push you away from this is because they make less money on it. Simply, you make about, as a lender company, you make about half the amount of money on a down payment assistance loan that you make on a regular loan. You guys can see I did more CHFA loans last year than anybody in the state, so we obviously don't push people away from them. We want to suggest those because if it's the right program for you, we're certainly going to work with you on that program. So that's CHFA. It's a great program. Metro DPA is another program. So there's two parts to Metro DPA, and the social equity I'm going to mention in a second. But Metro DPA, it's a great program. Interest rates are a little higher on it, and the credit score is a little higher on it. So the credit score, you got to be a 640 on this, but you can make up to $176,000 as a family or as a household. You don't have to be a first-time home buyer, and you can get up to 4% of the loan amount. And they do, you can have a cosigner on it. So Metro DPA, a lot of times, if you're a young person and you don't quite make enough money or you can't prove the money, maybe you're newly self-employed, things like that, and you need to kind of dive into something different. Maybe mom or dad has to co-sign, or a brother or uncle. Metro DPA is a good solution because you can do that with that program. Now, interest rates, like I said, are a little bit higher, but the big thing with Metro DPA, their silent second does forgive over 30 years. So even though the interest rate is a little bit higher, if you stay in the property, literally from the time you close, that silent second forgives every month, 1/36 every month, until at the end of 36 months it's gone. So there's a big advantage to using that. However, it's a little tougher program. Now, the social equity program that I have up on here to screen, just a great program. If you lived in certain areas of Denver, or your parents did, or your grandparents did, you just have to prove that you were a descendant of somebody, or you lived in one of these areas. There were areas that were discriminated against from 1939 to 2000, kind of in the Denver metro area. And it's not just Denver proper, it's a surrounding area. And there's a couple links that will be in those helpful links that, you guys can check whether anybody you knew, that was related to you, parent or grandparent, or you lived in one of those areas. It's a $25,000 down payment assistance that comes in the form of a silent second that, again, forgives over 3 years. And the interest rate is really good on that one. So the interest rate is actually, better than you would get on the open market. So if you do qualify for that program, it's definitely worth looking at, those links that are there. One of them will check the map. You can see the areas that were discriminated against, see if anybody in your family lived in there. And the other one is an application. They ask for proof. It's a little more cumbersome, but it is up to $25,000 that you don't have to pay back. So again, great program. So let's talk about income, because you have down payment, you have credit, who are usually the two biggest culprits to getting into a place, but income is a close third. So we do need a 2-year work history, so you guys know. There's a misconception that you have to be at your current job for 2 years. You do not. You need to have worked somewhere for 2 years. If you've been in college, if you were in college for 4 years, got a degree, or 2 years and got a degree, or 18 months and you got a certificate, you can still use that as work history. So college is work history. So if somebody's been in college for 4 years, graduates, and they're starting a job next week, we can use that job right away. So, or if you've been on your current job for 3 months, but you were in college before that for 2 years, you're fine. That gives that qualifies for the 2-year history. So if you're a wage earner, guys, and you make 40 hours a week, that's very easy. We take 40 hours times your hourly rate times 52 divided by 12. that is the income that we're going to use. So if you work variable hours, so you work 20 hours one week and 60 hours one week, and it's very inconsistent and back and forth, usually the guidelines will require that you be at a job or a job like that for 12 months for us to do an average. So that's usually what happens with variable income. But if you're close to that 40 hours a week, we certainly, it makes it a lot easier. Self-employed individuals need to be self-employed for 2 years. So they usually look for 2 years tax returns. They're going to take what you pay on taxes. So after you write everything off, whatever that net number that you pay taxes on, that's the amount of credit you're going to get for income. Now, there's some things we add back in. You can add back in depreciation and some mileage. So there are some things, and if you pay yourself a salary out of that company, that's also added back in. So there are some things. Don't just look at that net number and go, oh man, I can't, I'm not going to have anything. Work with us to take a look at those tax returns, and we'll go through them with you and let you know. And it may just be, there may be more there than you think. So, but that's kind of what we look at for self-employed people. More about income, bonuses, and overtime, guys. After 12 months, we can usually do an average on overtime. So if you consistently earn, on your current job, 12 months overtime or overtime for the last 12 months, we can do an average on that. If it's 2 years, we certainly can do an average on that. Bonuses are a little tougher. They want to look at a bonus, because bonus, they're talking about discretionary from the employer that you get for really nothing you did, just because you're part of the company. They do look for a 2-year average on those. Commission income usually requires 2 years. So if you're straight commission, they're usually going to require that you be straight commission for 2 years. Or if you're base plus commission, to give you the commission on top of the base, they usually require 2 years. However, in certain circumstances, depending on what your job was before, we can sometimes get by with as little as 1 year of commission. So if you've been doing commission income for 18 months or 16 months, don't wait the 2 years. Give us a call. Let's go over it. Let's see if we can use it. So there's always, where there's a will, there's a way. I think that, you've got to be very, you have to be very inventive in this industry. And I think that we're very good at figuring out, how to get people where they want to be. So Social Security, disability, and pension income are all accepted without restriction. There's no issues with that. If you've been receiving it, if any kind of payments that you're going to receive, and they're going to be for at least, like a pension, if it's 3 years, if they continue for at least 3 years, you're fine. You have no issues there. They don't conversely give you credit for government aid, such as welfare, unemployment, so rent subsidies. That can't be used as income, unfortunately. Student loans can't be used as income. The GI Bill can't be used as income. Those are questions we get a lot of, and unfortunately, they just don't count that as income. If you are a veteran and you get, or if you're in the military and you get, BAH, BAA, we can use that stuff, so that is something that we do add into your income. Calculation on income, guys, can be complex. So, if you're going through it and it's you're trying to figure out what you can use from for income or non-income, what that gross monthly income is, don't be afraid to ask us. That's certainly why we're here. So then we're going to go into which program is right for me. We've talked a little bit about FHA. FHA offers the maximum flexibility in terms of credit scores and debt to income ratio. Sellers can be a little less inclined to take FHA financing. Sometimes it's not, sometimes it's a stigma, sometimes it is because they require the safety hazards. If somebody doesn't have a smoke detector in there and carbon monoxide detector, they require that be fixed. Or if there's a railing missing, it's things that you would want as a homeowner to be fixed anyway. So it's not, not usually a huge burden to get an FHA financing loan accepted for sale. The big disadvantage for FHA is they do have an upfront mortgage insurance fee that is financing. You don't have to pay it in cash, but it's 1.75% of the loan amount. VA, if you're a veteran, there really is no better way to go than a VA loan. They have a funding fee up front unless you have a VA disability. That funding fee changes with how many times you use it, but it certainly is certainly is a great program because it doesn't have mortgage insurance, so you're just paying interest. So, and then you have conventional. You have conventional loans. Conventional are usually require a little better credit score. Usually you're in that 680 or above. The mortgage insurance is only monthly, so they don't have that upfront mortgage insurance. But compared to FHA, the debt to income ratios are a little more stringent. They're usually around 45% as opposed to 55 or 57 on FHA. And credit is, they need a little better credit score. So USDA, it's suitable for purchasing in rural areas. That's really areas that have less than 10,000 people. So if you're out of town, you get out of the metro area and get to some of the smaller towns, or you're living outside of town, definitely USDA is something you can look. Again, that's a 0%. VA and USDA are both zero down programs. So you don't have to use down payment assistance. You actually don't have to bring down payment at all. I'm going to mention non-QM just so you guys know what they are. So non-QM is kind of the out of the box stuff. We do those as well. So let's say if you're self-employed but you write everything off, you gross $200,000 a year or $400,000 a year, but after all of your expenses, what you show the IRS is that you paid, you made $20,000. There's advantages. Obviously, those guys don't want to pay any more in taxes than they have to. So, so they're gonna, so they go to one of these programs. They usually require a bigger down payment, either 10% or 20% down, depending on credit score. But what they do is they'll take an average of their bank statement deposits. So they'll take their business account and they'll add up all the deposits for a year, for 12 months, whatever that is. They usually give you 50%. So let's say you're at $20,000 a month in deposits. For this program, they give you 50% of that, and your income you could use would be $10,000. So don't use that program unless you have to use that program. But a lot of self-employed people would actually, with the interest rates being higher, would actually pay $1,000 more in their mortgage than go pay, $100,000 more on their taxes. So, though you run into those. If somebody has an ITIN, that's kind of the program. You can't do regular FHA or conventional or VA or USDA financing if you don't have a Social Security number. There are investment properties. If you get to the point where you want to start buying investment properties, definitely, and you don't have the income to really qualify for that, debt service loans are a way to go. That property, if that property's rent will pay for it, you can do a debt service loan. Again, most of these programs require a bigger down payment, either 10 or 20% down. They're kind of one of those necessary evils. If you need to use it, it's because you can't go the traditional route. It'll be more expensive, but still a good situation for we do a lot of them. So for many people, it still works out well. So if you guys are still on the fence, I understand there's a lot, we're throwing a lot at you today. If you bought a house 2 years ago, the average homeowner gained $50,000 in equity in Colorado. So, when you're asking yourself 2 years from now, hey, remember that webinar we went on, we should have maybe jumped in. Well, that might be $50,000 cost by waiting. Achieving homeownership is possible. Our team's here to assist. We want to help you purchase your dream home. That's what we do every day. Thousands of people we have helped, and we're very proud of that. I'm a big advocate of homeownership. I don't just do this because I like to do mortgages. It's very rewarding to help people buy their first home and their second home. People just like you are buying homes. It's not just people with rich parents and things like that. We do loans to every walk of life, whether they are a guy driving for Amazon, or an attorney, or somebody working in the hospital, or teachers. It doesn't matter what you do. If you have that will to get there, our whole job is to help you get there. So, remember, we've all lived in that place where you can't hang something up because you're afraid to put a hole in the wall, or you can't paint a wall. So, personalizing your space is a big thing, and having your own, space that's yours. It's hard to compare. It's hard to compare when you're renting and you've got the constraints of a landlord. So, and why would you want to contribute to somebody else's wealth when you could be contributing to your own wealth? You know, we just have seen so many stories. I have countless stories of people who have purchased homes and they come back to us 2 or 3 years later to either sell that home and buy a new home, or maybe they want to consolidate that debt, and we, you know, we take a look at their house and they've got $100,000, $200,000, sometimes $300,000 in equity, you know, and we all know it's really difficult to save money in this, and that goes in this economy, and that goes back to building wealth. You know, it's still the single best way to build wealth. So we would love you to get started. So in the links, you can always go just directly to this website down here, www.apply-nickbarta.com. That takes you to a short application. It takes you 5 to 10 minutes to do. We will have either me or one of my mortgage consultants, you know, we'll go through it. We'll go through your application with you. We'll get you ready to buy, and we'll go through everything. We'll go through everything we just talked: credit, income, your down payment, you know, the type of property you want to buy. So, you know, we definitely are excited to help you in any way we can. So I'm going to give you some bonus tips. These are just things you need to know when you're buying a house. Use a real estate agent. It doesn't cost you anything. So big misconception: oh, I don't want to pay a real estate agent. Well, as a buyer in the state of Colorado, about 98% of the time, the sellers pay the real estate agent. So very seldom do you have to have. They may have a little admin fee or something like that. You know, it might be $300, $500, but that's the only cost. And so trust me, when you go and you do an open house and that listing agent is there and he is trying to sell that house, and he's the nicest guy or she's the nicest lady in the world, make no mistake about it, they are there and they are working for the seller. So you're not represented if you were working with them. And if you're going to not pay for it anyway, I would definitely suggest, you know, having somebody on your side. If you don't have a real estate agent and you're looking for one, we know several reputable real estate agents that we work with over and over again. We'll find out what area you're looking at. Some agents are better in different areas. Some agents are better, you know, with different programs. So, you know, ask us about that. We can certainly help you with that. You know, I'm a big advocate of local over the online guys or the call center guys. You know, my team goes to their kids go to the schools that your kids go to. You know, we go to the grocery stores that you go to. You know, we understand what it's like to live in Colorado, and so, you know, we'd love to work with you here. Also, determine your budget, because we're going to give you your maximum. So we're going to tell you what's the most you can buy. That doesn't mean you have to buy there. So, you know, if we say, hey, you know, make good money, and you're, you know, we say, hey, you can qualify for $3,500, and you're like, okay, hey, $3,500, that is way more than I want to spend. So communicate that back with us as a lender. Tell us, hey, you know what, I'm okay at $2,600. You know, and then we'll figure out kind of what a property looks like at $2,600. And then you have that flexibility to know, hey, if you find your dream home and it might cost you another $50, you've got that flexibility to do. So you can dive in there and do that. And then the other big thing would be, don't hesitate to ask any questions. There are no stupid questions. We do this every day. We know that this is a very big transaction. When you buy a house, it's a big transaction. We want you to be as comfortable as possible. If there's ever a time when you're not comfortable, then you need to tell somebody that. I don't know what you're asking. You know, a lot of times in the mortgage industry, we use acronyms and we throw things out very quickly. And you just need to, you can always tell us, hey, I need to know what you're talking about, or I don't understand what you're looking for. You know, it's our job to make sure that this is as stress-free as possible for you guys. That's really the, you know, if you're looking for a lender and you know, and that's not their goal, then you're looking at the wrong lender. So guys, I want to thank you for oops, I don't know where I went. I want to thank you for taking a few minutes to hang out with us. I'm going to see what we have for questions here real quick. Let's see. It looks like we just have all the links in the chat room. So if you guys go to that chat room, if you guys have any questions, certainly, pop them in the chat room, or you guys can always, we'll send you our contact info. My email is nbarta@securityff.com. You can email me at any point in time. You'll have my contact info. It's been a pleasure hanging out with you guys for a little bit.